Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate with your host, Kevin Perenio. As an owner and C-level executive for 20 plus years in finance, KP is here to serve you with all of his knowledge and experience. Whether you're a broker, realtor, or just interested in the economy, this is the podcast for you. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. Well, hopefully everyone is slapping the hell out of month end, slapping the end of March, and slapping your way through spring purchase season. It is rock and rolling time. And despite rates shooting up in almost record numbers, it's a very, very strong housing market right now, especially for those that are doing and focused on purchase business. We have seen a meteoric rise in interest rates. It is one of the quickest rates rises we've seen in a long time. And that's because it's kind of running parallel with inflation being hot and the economy running hot. And, Jerome Powell, the Fed chairman, would like you to keep the word inflation out your mouth because he talked about it being transitory. And now that's just been slapped right out of the vernacular because it's been pretty persistent. And we've noticed about 100 basis points increase on the 10-year Treasury up to basically 250 basis points. We're watching mortgage-backed securities climb. We saw 500 basis points get sucked out of the rate sheet on the 3.5 coupon here year to date. We have, I think, only one other time seen rates rise this much, this fast, in such a short period of time. And everyone's noticing it. We're seeing locks up quite significantly here in March, not just because it's a long month, 23 working days, business days, but, basically because people are trying to get off the fence. I mean, there's some serious FOMO setting in, like this rate that I could have got yesterday didn't exist. And so I think generally the originators out there are doing a really good job, but this persistent inflation has shaped what the Fed is going to do. And ever since a couple weeks ago, when Jerome Powell was out there basically talking about, not taking a 50 basis point rate hike off the table, he basically said, we may have to take a little bit more drastic measures. So the stock market has baked in a 50 basis point hike at the next federal funds meeting. Even though in the first one, they did a 25 basis point hike and they said that there will be 6 more rate hikes subsequently, the market is now baking in 50 basis points. And so how that really affects what we do, think about this. The bond market is massive, right? Let's call it a $11 trillion market. And stocks and bonds fight for money. There's the money supply, and there's credit supply, which is like, over 10 times larger. It's $50 trillion in credit, all in around the world. People put money when they want to take risk into stocks like equities and make money. When you don't want to take risk and you don't want to lose money, typically you're putting in money in bonds. Now, again, I'm not a financial advisor. I'm not responsible for your losses, only your profits. But I will tell you, this age-old battle between stocks and bonds, it's been a big part of what's caused the choppiness, in the stock market and with our rate sheets. There has been a lot of uncertainty. There's still uncertainty. There's a war going on. There's a pandemic's kind of winding down, sort of, unless you're in China, which they didn't really vaccinate. So, there's always something new getting thrown our way. But we have to look at the data. And so while the Fed is trying to tackle inflation, which has been persistent, has been, more than their original definition. Well, remember, the original definition of transitory is anything not permanent, right? So, of course, nothing lasts forever, just like there's going to be a recession around the corner at some point, especially if you see a inversion of the yield curve on 10-year bonds and 2-year bonds or 10s and 30s. But, it's this persistent inflation can be fought by the Fed raising interest rates. Now, when the Fed raises interest rates, that tends to put a little bit of a damper on growth, which cools down the economy, which helps to ease over time some of the inflation. Now, the good news on the labor side of things is jobs are still rocking and rolling. The employment situation is fantastic. There was like 177 or 197,000 weekly jobless claims last Thursday. It's supposed to be like 210,000, so that was good. This Friday coming up, is the March jobs report. Remember, that's the second half of February and the first half of March. That's about how long they can collect the data and they get it all together, compile it. And then the first Friday of the following month, which is this Friday, April Fool's. No premature April Fool's jokes, please. You may get Will Smith, but we are having a big jobs report. It's supposed to have 460,000 jobs created in the month of March and bring our unemployment rate down from 3.9% to 3.7%. And according to Elliot Eisenberg, we still have about 11.1 million job openings. That's slightly down from 11.3 million job openings, which was a record number in December. So are these little signs of slowing? We had new home sales come down a little bit into the 700,000 range, down from the 800,000 range. All these little data points, where are we seeing the slowing? Where and when will it come? Will it come eventually? Of course. We don't know how, but when you start talking about recession, which is 2 quarters in a row, 6 months of negative GDP, when will that happen? What is the impetus to make that happen? Maybe some of this rising of the interest rates, that will be what helps to cause it. Maybe people stop quitting. The quit rate of jobs has slowed down a little bit. It's come down from its peak. People are unretiring, and more people have entered the labor force. And so, we have to look at all these factors. But employment situation is great right now. Hopefully we get some confirmation and another good data point on Friday. Excuse me, about that. And then, of course, we'll tackle inflation with the Fed's measures. Now, another big thing that's going on is that President Biden, they submitted their budget to go through the process. And the big headline was the billionaire tax, a wealth tax, if you will. So basically, if you make $100 million or more, or have $100 million or more in assets, which, by the way, is not a billionaire. It's only 1/10 of a billionaire. But anyway, they're calling that the billionaire tax. Just sounds cooler, I guess. I guess you can't call it the 9-figure tax or the 10% of a billionaire. I don't know. But anyway, if you're making $100 million and you don't pay 20% tax on the income you report, then your assets and your unrealized gains can be taxed according to this proposal. We'll see if it passes. Interesting. Something new. Something progressive. I know. We're not exactly raking it in when it comes to collecting money from the wealthy, but there's pros and cons to this, and I ain't going to get into that. But it's been proposed. Just kind of reporting the news to you. Saturday is Ramadan, so for those that celebrate, I think it's Eid Mubarak. I'm gonna have to get that one. I see it. Everybody type it everywhere. It's kind of like saying Happy Ramadan. But I'll go find it for you. I don't want to be. I don't want to disrespect anybody here, but big holiday, huge religion around the world, and that starts on Saturday. April Fool's on Friday, and Blue Origin is launching a rocket, a manned rocket, a personed rocket, if you will. That's happening today, and we just had on the 20th of March the vernal equinox, and that is the half daylight, half nighttime on March 20th. It actually here on the West Coast was 8:33 a.m., I believe. So the days are now getting longer than the nights. That means the sun is slapping the moon and keeping the daylight out of its mouth, I guess, if you will. I hope everyone has a great rest of the month end. Cheers. Hey, it's KP coming to you live from Corona, California. Well, there's a big difference between the map and the terrain. And we're going to talk about how to get you from point A to point B. But congratulations, you survived Q1. It's over. 3 months of the year over. There's only 3 more quarters to go. Can you believe that? And we're already in officially spring. Lots of news going on. And it's all about housing. It's about jobs, about inflation. It's about the Fed. That's all the main stuff. But I heard something very interesting. I want to lead off with this little tidbit. There's a guy named Tom Lee from Fundstrat, and he's on CNBC every now and then. And he's a perma-bull. He always tries to find the bull case for the economy. I love it. It's basically the ultimate optimist. And, that's how I try and be here myself. he said something talking about housing, that for every new homes built, 250,000 new homes built, that increases the GDP by 3/4 of a point. Now, I've never heard it stated that way. I thought that was very interesting the way he said it. And those jobs created, there's 4 jobs created for every house. So it was very interesting to hear about that. So when I see stats like new home sales are coming down, like the February number was a 810,000 anticipated read. It was only 772,000 in the read. Now, of course, that's seasonally adjusted. Will that go up as we get into the longer months, the spring purchase season months, the big months? We'll definitely see about new home sales and how that impacts our economy, because people are using the R word. They're talking about recession, and they're talking about it a lot. And so, slowing growth does not mean negative growth. And so there's a big difference. We talk about our housing stats all the time, that, there's appreciation in housing, but you can have slowing appreciation and still have, a healthy, strong housing market. So let's talk about the 10 and 2-year treasuries, the yield curve inverting. Everyone is talking about that, and rightfully so. It isn't an indicator every time that there is a recession coming, but every time there's been a recession for the last 8, there has been a preceding inverted yield curve. So the 10-2 is probably the most popular yield curve to look at, a 10-year treasury and a 2-year treasury, right? Treasuries are, it's debt being issued by our government, by the Fed, by the Treasury. They're basically raising money. They're increasing the supply of currency. You've got debt and credit, and this is what makes the world go round. So when the yield on a 2-year note is higher than the 10-year, that is people basically saying, hey, you know what, there's trouble ahead in the economy, and we're not really sure where it's going to go. We don't want our money tied up for too long in these treasuries, because you've got a recession coming, right? So there's maybe better yield ahead, and they want to save their money to be able to put into higher yielding treasuries down the road. It's very interesting to see, how this 10-2 curve is impacting the recession talk. Now, will there be a recession at some point? Of course. Credit cycles, debt cycles, they take anywhere from 5 to 7 years. And, it's been a little over 2 years since the start of our recession. This month, actually, happy anniversary. 2 years to stop the spread. But, this 10-2 inversion that's gone on, it didn't close yet. Okay, so the end of the day, the 2-year treasury closing was not a higher yield yet than the 10. Now, the Fed likes to look at 3-month to the 10-year, or maybe 6-month treasuries to the 10-year. They look at some other numbers as well. And of course, they have a lot more data than we do. Are there cracks in the credit market? There's talk of, some of these commercial buildings, that this commercial mortgage-backed securities, which are massive, massive debts. I mean, humongous debt in these fixed income, fixed asset securities. Look at all these buildings. Look around you. I just walked my building today. I handed out my second daughter. She's 6, almost 7 next month, and she had about 2 big old boxes of filled with Girl Scout cookies, and we already pre-bought them. And she wrote me a little note, and she said, Dad, can you take these cookies and give away? Well, I mean, who am I to disobey my little 6-year-old? So as I was walking the halls at 4 o'clock, ain't nobody here. Now, I mean, it is 4 o'clock, so we have a lot of early birds and we have some East Coast hours. But, why do you have all these spaces? For hybrid work schedule, for the boom that's coming in housing, so we can refill, and we're hiring like crazy. We are very busy. We had a very good month. We had a very good quarter. We have not had layoffs. We've had a really good run. We feel blessed that we've been able to pivot to purchase business. Our campaign all of 21 was Path to Pivot. And we've been doing more purchase business since, May of last year. And here we are wrapping up March. And so I walked that hall and I say, it's very interesting that we have all these buildings. So are there credit cracks in these commercial-backed securities? Or how about high yield corporate debt? Some of these companies that might not make it if growth slows down. Now, if we go into an actual recession, which is defined as 2 quarters in a row of negative growth, negative GDP. That's 6 months of negative growth. Not holding, not slowing, not just barely above zero, below zero for 6 straight months. Now, in the past, there have been, out of the last 9 times the 10-2 yield curve has inverted, only 8 times did a recession come after that. Now, recessions, of course, having 6 months, 2 quarters in a row of negative GDP growth, that is could happen in 24 months. It could happen in 12 months. One of the recessions after a 10-2 inversion took 24 months to happen. And so when I say there's a big difference between the map and the terrain, we may go from this point now and have slowing growth, and then at some point, eventually in the cycle, have a recession, of course. But how do we get there? We could have ups and downs, it could be very choppy. I mean, for those of us that trade stocks, it was rough the first 2 months. And then the last, 7 sessions, 11 sessions really were pretty positive in most places. Tomorrow could be a new day. It's a new quarter, a new month. The 10-2 inverted midday today and yesterday, and quarter end window dressing, which goes on in the stock market, where a lot of money managers, they're buying stocks at cheap prices that have been pumping up these last couple of days to look good on the statements for their clients at the end of the quarter. Tomorrow's a new quarter. So we could see a sell-off tomorrow, and that could start to drive things down. You still have a lot of uncertainty out there. But what brings certainty are data, math, and facts. And so I won't talk anymore about the stock market. I'm not responsible for your losses, only your profits. I am not a financial advisor. Go talk to someone who knows what they're talking about. But I will say that if the stock market comes down and, you've got all the stuff going on with inflation and the Fed, earnings is usually a sign. That's a data point that would show why we are slowing. Are we going to have less earnings growth, slower earnings growth? The supply chain issue is hurting a lot, right? We've seen even purchase mortgage applications down in some of our weekly data reads. So we're going to look at math, data, science, and facts. We're going to look at the data. Tomorrow, massive data point comes out. The March jobs report. First 2 weeks of March going back to the second half of February. That's our March report. There's about 460,000 jobs anticipated to be created. And the ADP payroll report showed March was 455,000. And, it's usually, they're not always, running together, but that would be a lot of jobs created and still a healthy market, a healthy sign. We'll see if the unemployment rate goes down from 3.9% to 3.7%. There'll be interesting data points in there. Did more people unretire? Did more people jump back into the labor force and decide to participate? What is the overall number of the labor force? It's very interesting data. It's not just the headline number. So we're going to look in there. Core PCE, personal consumption expenditure, which is the Fed's favorite number of inflation that they look at, was 5.4%, up from 5.2. Now that's less than the 7.9, the high 8% number we get on CPI, the Consumer Price Index. And as the good folks at NBS Highway like to point out, CPE is probably used by the Fed because it has less of a weight on housing, which, as we know, is through the roof. I just have a tenant going into a property paying $7,500 a month in Orange County. It's absolutely insane. I mean, I can't even believe that that's what the market bears. Lots of stuff going on here. I'm going to wrap up real quick for you, but we got some big data points. We got to take a look at this stuff. Okay, so DC budget came out. There's about $71.9 billion earmarked for HUD. That's 19% up from last year. And it will be interesting to see if that money makes its way over here. $8 billion in buybacks last year. The GSEs are hurting for money. Have a good one. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.